Top That Trade Time with Alan Nachman, a pro trader with Agora Financial, and Phil Flynn, a Fox Business Network contributor. Let's get you going, guys, with round number one. Fat Cat Catterwall. That seemingly unfounded explosion of GameStop stock has everybody's attention as those millennials and Gen Zers outsmart the big hedge funds. Who do you say are the winners and losers in the new irrational exuberance?
Wow, this has been some action in the markets for sure. So I'm going to say YOLO, here we go, bros. I'm on your side. So for 100 years, the axiom has been that money's not made or lost, it just moves. So it's interesting now that it's moving to these retail traders. They're not doing anything wrong. All they're doing is buying a stock and it goes higher. No one complained when the hedge fund made money when it was going lower. Hedge funds made billions of dollars, but now the shoe's on the other foot. So it's giving people a little bit of pain.
It's revenge of the nerds. That's what it is. This is revenge of the nerds in real life. This is awesome. You know, and it's about time the Joe Q public win. For years, every, smart guy on Wall Street would look at what the retail guys are doing and do the opposite. They would make money for generations. Now the retail guys are getting smart. They're looking at what the big guys are doing. They see where they're vulnerable, especially like selling like 180% of shares of the stocks that more don't even exist. And then they say, hey, wait a second, these guys have, there's more shares short than are in the world. You can buy them. They have to buy them back from you. So that's what's driving the price higher. The shorts were too confident.
Dumb money is turned smart. It's smart money is mad. That's all it is.
Round number two, short shove. The crazy moves in GameStop, AMC, and Nokia have been squeezes on short sellers. What's your trader trick to make sure you don't get caught on the wrong side of the trade?
Well, for the average investor, that means never go short a stock. That's right. One thing when you buy a stock, unless you're doing it with an option where you can control your risk, but the average investor shouldn't be going short stocks. They can use options where the risk. Why? Because the risk is unlimited. I think you're seeing, billions of dollars are being lost by the so-called smart people because they got overconfident that this brick and mortar store GameStop was going to go bankrupt. Well, guess what? They didn't go bankrupt. The smart guys are the little guys, and they're seeing these vulnerabilities in the market. I think it was hubris on the big short sellers. They thought, hey, brick and mortar, who's going to be buying video games in 5 years? It's going to go the way of Blockbuster. But the guys that grew up there, and spent money there, they might know that business better than the big guys. And I think they're proving that at least right now.
The word you used was humorous, and it is humorous, but it's also hubris. It's humorous getting beat here. A short squeeze, it's just math. A short squeeze can only go to zero. So the market can only go to zero. But if you get squeezed, the market can go to infinity. So that's what's happening here. So what's important here, it's about making money. Making money is not the toughest. Taking the money is the toughest. So now these guys have to learn some lessons to be successful with money management. Let's see what happens.
You don't want to be squeezed. That's bad.
Here's your round number three, season of pleasing. Earnings are much better than expected. What would that mean for the market momentum?
Apple came out this week. They made $30 billion in profit for the quarter. Let me just say that again. $30 million in pure profit in one quarter. Now, that's fundamental facts that can support a stock market. And we've seen a lot of these stocks come out with better earnings than expected. That's very positive. The other stuff will be news and noise, but that's what truly drives the markets is how much money corporations make.
And I think that's a big part of what drives stocks. And Alan's absolutely right on that. But at the same time, I still think there's some stocks you have to be careful with. You just can't buy any stock and assume the earnings are going to be great and it's going to go straight up. There's a lot of stocks right now that are trading many times earnings. Sometimes that's a good thing. Sometimes it's a bad thing. You have to look at the individual company. A company like Tesla, for example, what is it, like 5,000 times earnings right now? But, people believe that stock has a future. But there's other stocks, of course, that might not have as bright a future that are trading beyond earnings. So you got to be very selective, I think, in this market.
So the one thing to remember is the markets can remain irrational longer than you can remain solvent.
For the bonus round question for today, the January effects average return is 1%, 1.8%, or 2%.
I'm optimistic, too.
I'll say 1.8 just to be different.
Well, good to be optimistic because this January's return has not been added in yet. But going back, the average return has been 1.8%. We have a winner. Business First AM continues right after this.